Here we go. The stream is live. Good morning to everybody in Europe. Good afternoon to everybody dialing in from Asia and the Middle East. My name is Lutz Preussler. I'm responsible for the business development part within the asset management team. And today I'm joined once again on like every month here with our head of research, Katalin Tischhauser. The theme for today and this month is when bull markets, decoding the disconnect. Katalin is here to walk us through the most pressing topics driving macro and the crypto industry. As always, all content and opinions presented in this live stream do not constitute any investment advice. So after the last couple nights of fresh announcements from the White House, let's dive into two macro stories that are driving markets in our opinion right now. So news and headlines couldn't be worse, but financial markets are at the top. S&P hitting 6,200 last week. Is this a typical buy the rumor, sell the news environment? And if so, what rumors are investors buying, Katalin?
Well, the rumors are not really positive, so I'm not sure why why anyone would be buying them. And really, it's a very interesting situation. And as you said, there are two major themes on the macro front that are going on currently, and neither of them are actually positive, certainly not sort of medium-term positive. Maybe there can be short-term positive effects in terms of how things are actually unfolding sequentially, but fundamentally they're both destabilizing. And one is the tariff situation, the other is the deficit situation. And on the tariff front, actually, the markets did pull back yesterday when Trump started sending the letters out. But as you say, last week when he was already saying these things, in fact, he was saying that some countries will get an even higher tariff than what he proposed on Liberation Day, right? So that was already, the news was already out there. And as you say, the S&P made new all-time highs and so on. So it is really interesting to think this through, what exactly the market is trading. And basically what we're seeing unfold now on the tariff front is that yet again a reversal. Previously, Trump said he was gonna postpone the deadline, which is coming up tomorrow. And then suddenly he imposed these tariffs, but then again, they're not going to take effect until the 1st of August. But then again, he also said yesterday that if countries ask for that 1st of August deadline to be postponed for some reason, he's completely open to that. So it's basically just still a lot of uncertainty. If he does go ahead with these punitive tariffs, that's negative. That's bad news. It's negative for global growth. It's negative for US inflation. And if any country, then it's even worse. If they don't, then at least they have a kind of deflationary for the countries that get the tariffs imposed on them, and recessionary, and at least the central banks and governments can respond with fiscal and monetary stimulus without any problems. If they engage in a trade war, then that becomes more complicated as well, because then they also have at least short-term inflationary effects from tariffs they impose on the US in return. So in either situation, it's not a positive. And as far as the US is concerned, there can have pro-growth benefits from the tariffs. However, they are not instituting other policies that would support growth, for example, building infrastructure and so on. So there isn't a policy package that's really kind of taking this in the direction of strong reindustrialization. And in terms of companies relocating to the US, that is very likely to happen. However, it's delayed by the ongoing uncertainty, which still carries on. And also we have seen some companies deciding to relocate from countries, but not to the US, but to China, because there are trends happening there as well. It seems that the market we'll see whether yesterday's move is going to be sustained. There was basically a pullback yesterday. So, but basically up to that point, the market seems to be shrugging off this risk. This is a risk, this is a negative, and the market says, we don't care. Now, this has been the correct trade over the past few months, basically what they refer to as the taco, the Trump always chickens out, which is not to be taken literally. It is just that these dire outcomes don't actually materialize. So it's been correct to trade the opposite, that these things will not actually happen. And I also wonder why Trump reversed. We see such frequent reversals from this administration that to some extent it's almost like, why even ask what the reason is? There's probably no reason. But if there is a reason, it could be that it's linked to the Big Beautiful Bill passing, and which is basically negative for the budget deficit, and maybe the revenue from tariffs would be offsetting that to some extent, to be honest, not to a very great extent. And if this gets delayed and it's the 1st of August, then maybe not even that, then it's more just posturing rather than actual revenues actually happening, because that's not happening yet. But it could be that the administration wanted to signal that the budget situation is not going to be so bad because we're going to get all these revenues from tariffs, but then actually the tariff situation sort of fizzles out over time. That's certainly how the market seemed to position itself. And when we come to the other uncertainty, we're already alluding to the budget deficit. It's escalating, the debt is escalating, there's nothing to stop it, there's no mechanisms, no incentives, and that's obviously destabilizing. It's very unhelpful for this kind of sell America, loss of faith trade that's been going on over the past month for the bond markets and so on. However, in the short term, actually, we will see a fiscal stimulus, because the tax cuts and so on come into effect very quickly, and the cuts to benefits and so on, the kind of cost-cutting measures, more like the end of next year. So we can actually see a short-term stimulus, but that's not very much. It's more a sugar high than a kind of pro-productivity policy, especially as the tax cuts mostly benefit the high earners, which translates into less consumption. There isn't infrastructure investment and so on. So a lot of the costs, the increased expenditures of the government go towards unproductive things like defense and interest payments, as bond yields remain fairly high and so on. But there is this short-term fiscal stimulus, which again the market trades because it's a form of liquidity. We'll have to see where this all lands, because when we look at for example, the VIX, the risk metric, it's still very low. It moved very little in the context of all these policy changes, the Big Beautiful Bill introducing risk. Yes, fiscal stimulus, but there's a lot of risk there with, the debt and the deficit and the tariffs introducing risk. And there's also the geopolitical is rearming, and there's statements that they're likely to attack Iran again, which can have knock-on effects on the oil price and so on. Which these are risks that the VIX as quite a strong metric of the market, telling us where they see the risk is not pricing in. So we still have the liquidity trade in motion. Generally recessionary or slowing global growth and monetary stimulus in most countries, lower dollar. Generally it reversed again a little bit, but still it's pretty low. Oil prices are pretty low. All of this is providing global liquidity, and we are seeing even in the US various stealth QE running down the Treasury General account. So liquidity is lifting financial assets, and the market is pricing in more of that to come, including the fiscal stimulus from the Big Beautiful Bill. But I think the market is complacent about risk.
Right, exactly. And we kind of saw it last week already. I mean, when non-farm payrolls came out, right, and like better than expected, like not a super strong print, but a semi-strong print, and then fixed income markets immediately reacted, right? I mean, the 10-year Treasury traded a bit.
Right.
All of this just adding on to what you mentioned of like more debt, higher rates, higher refinancing rates, and so on. So this is just a big macro topic that will continue to be part of this administration and this story. It won't go away.
Yeah, and I'm on board with the liquidity trade. That's really happening. Liquidity has been the #1 driver of financial assets since 2008, when kind of these long-standing macro. I'm just pointing out that there are real serious risks there, and they're not really priced in.
Right, exactly, yeah. So we should watch out for them, right? That was the first part of the bigger story. And the second part that, of course, has been hitting the news a lot as well, and it's been pretty obvious that President Trump made it clear that Powell's term is coming to an end, right? I also recently saw there already bets going on Polymarket on who might be the next Fed chair, right? What implications will this have, whoever will succeed Powell as the Fed chair?
I cannot see any of this as good news. Jerome Powell is highly competent, and he's been a point of stability. And especially when other things have been going off the rails and there's more and more uncertainty all around, geopolitically, economically, macroeconomically, financially, fiscally, and so on, he's been a steady pair of competent hands. So, anyone else who takes over, and there's a lot of speculation, but at the very least is an unknown. It's a point of uncertainty. But generally, the markets like Powell. And for example, when Trump made the announcement, or he said that he will name, very soon, he will name Powell's successor. So basically, Powell's term is coming to an end in less than a year, in some months. And based on, obviously, the rhetoric from Trump, I think we can be fairly certain he will not be renominated for another term. I think, well, we might be surprised, but that seems unlikely. And then Trump said that quite unusually, new nominations would not be announced this early, but he wants to announce the new Fed chair soon. That's what he said. So, we'll have to see. And clearly that implies that this would be someone that's not Jerome Powell. And immediately when he said this, the dollar, for example, sold off. That's when it went below 97 towards 96. And so clearly the markets don't like that piece of news. And I don't fully understand, unless it's some 5D chess game of getting the dollar lower, unless, this is some kind of incredibly clever and convoluted game of manipulating the market into trading the dollar lower. But I don't really understand the US government's insistence and Trump's insistence on cutting rates and, typing social media messages in all caps, yelling at Powell to cut rates by 1% and so on, because actually the backdrop doesn't justify a rate cut. Powell is absolutely correct that there is huge uncertainty on the impact of tariffs. In fact, there is huge uncertainty on what the tariffs will be. When you don't even know what tariffs are going to be actually implemented, obviously you definitely don't know what the impact of that is going to be. And I think yesterday people started assuming that maybe the tariffs will be worse, more punitive than what the market had been assuming, and maybe not. Maybe this is just another head fake. But and also we have seen that a lot of in the uncertainty, importers swallowed a lot of the 10% that was already instituted. Importers swallowed a lot of it and didn't pass a lot of it on to consumers, just basically waiting to see how things are going to turn out, but that cannot be sustained. So whatever readings we have seen on inflation up to now, we cannot really read very much into it. So I think it's absolutely correct to say that we have to wait and see what the impact, what the policies will be, and then what the impact of those policies. Because cutting before that will just break the bond market. We had the example of this last September when the Fed actually cut more than the market expected. And at the time, the bond markets weren't even as fragile as they are now after, things that have been happening with the Moody's downgrade and, all those kinds of things pushing above 5% for the 30-year and so on. At the time last September, actually, the bond markets were in a much better shape. And they sold off very steeply. I think over the weeks that followed, a 70 basis points rise in the bond yields or something like that, as I recall. But basically, it was bad because the market said this is going to be just inflationary. This is not justified, therefore it's going to be inflationary. And if bond yields rise, they offset any stimulative effect from the rate cuts. Actually, the net effect will be the opposite of being stimulative, so actually counterproductive. So I don't really see, and obviously the US government and the Federal Reserve, the Treasury, working together, they have been very creative in providing liquidity through various means that is not rate cuts, when the rate cuts have lost their effectiveness and are counterproductive to, a rise in bond yields, which is actually worse than, any benefit from the rate cut. So, of course, quantitative easing was the big invention some decades back and used after the financial crisis, but other various what people describe as stealth QE. So liquidity is sure to come because they need to avoid that the system breaks, and it's already pretty precarious. But this focus on rate cuts seems to me quite irrational, and in this regard, because the story is that the new Fed chairman will be much more dovish. The new Fed chairman will cut and cut and cut, and I think that could be quite counterproductive. And I also think that Powell will cut when the backdrop justifies that, and he's acting very prudently.
Right, exactly. Yeah. So lots to come. See how this comes to an end, and who will ultimately take over from Jerome Powell with the implications.
Yeah, but maybe they're just saying these things to get the dollar lower.
Exactly, and it is pretty low, right? So you would think all the exporters of the U.S. goods, like people should just be craving to purchase U.S. goods, right? So it should benefit all the exporters in the U.S. But so far, looking around, I haven't noticed any of that. So then, and we will see it in the dollar ultimately rising when demand for those goods go up, right? And as of this morning, that is not the case. Exactly. Yeah. Right. Yeah. So let's turn it into crypto a little bit, right? And we talked about like this disconnect between financial markets and the macro news on traditional markets, especially equity markets. Now, Bitcoin also close to all-time high. I would argue that there is definitely similar pattern there, but the rest has been lagging, right? Why is crypto in general lagging when traditional risk markets are rallying?
Yeah, this has been odd. I think the expectation really was that whatever is driving liquidity and whatever is driving risk assets would also be driving Bitcoin and crypto. That crypto should be the faster horse or the fastest horse. And on top of that, these extremely, extremely positive supply-demand trends, at least for Bitcoin, but also for some other crypto assets, increasingly because of the institutional inflow into the ETFs, which has been very, very strong and just is ongoing, huge inflows, and also these Bitcoin acquisition vehicles, and now other, for other tokens as well. But the Bitcoin ones they're purchasing a lot of Bitcoin constantly, and the number of these vehicles is growing. And what they purchase, they remove from the liquid supply because these vehicles never sell. Unlike ETFs where, obviously if the guy sells the ETF, then the ETF issuer sells the Bitcoin on the other side, vice versa. But with these vehicles, that's permanently removed from the liquid supply. So the supply is shrinking and the demand is growing, and plus the macro backdrop and risk assets making all-time highs. So really the expectation would have been that Bitcoin breaks out of this 100,000, 110,000 range and starts galloping up by now. And what has been recently holding Bitcoin back is actually, what we are seeing. I mean, we're interpreting kind of what we hear and what we see, but that there has been a lot of very long-term holders of Bitcoin that kind of feel at these levels, they want to take profits. People who have been holding Bitcoin from $100 and would never sell, but suddenly when it's above, it's kind of a psychological level, and above 100,000, there's just a lot of these OG holders who say, that's a lot of money, and I just take some, just take some chips of the, it's not even that they're bearish on Bitcoin, which they're not, and it's not even that they don't think it's going to rise. It's just, I take some, I take some of this at these levels, I just monetize some of this and have a great life, or it's really a very psychological level being above 100,000, and it could, for example, you remember when last year Mt. Gox distributed quite a lot of the Bitcoin from way back 10 years prior, and the market was very concerned about these distributions would lead to selling pressure, and they didn't. Like, there was almost no evidence of selling pressure. But then these people who got their Bitcoin last year and they thought, okay, I'm still bullish, I've been forced to hold it this long, and everything looks great. Trump's just coming into office. U.S. government is just getting on board with crypto. I'm not selling. But that, for example, these Mt. Gox creditors that got their Bitcoin a year or so ago, maybe now above 100,000, they say, I made so much money since 2013 or whenever on this. Just take some of it. So, and then we had these wallet movements that really rattled the market, wallets that hadn't been touched. Some people say they're Satoshi wallets. That's completely unconfirmed. These things are just speculation or rumors, but almost 10 billion, it was like almost 9 billion, something like that, worth of Bitcoin moved in 6 wallets from, not sold, just wallets that hadn't been touched since 2011 suddenly moved. The Bitcoin was moved. So there was concern. Is it, are these holders, thinking about taking some profits or selling some Bitcoin? And the amounts were so large that's been quite concerning. So I think it's very hard for the market to break out of this 100,000, 110,000 range. We have seen that with our eyes, and there is definitely this barrier that we require either a very strong catalyst, which could be, for example, the US government starting to buy Bitcoin. They keep talking about it. They keep announcing that there's a plan, they're going to do it. There's a great plan, it's coming, but we haven't seen it yet. Something like that can be very powerful, because if central banks actually buy Bitcoin, it's one thing to move the seized Bitcoin here and say it's now reserve, but it's quite another to say we are buying. We are going into the market and buying. So that could be a catalyst. There could be things we don't expect, obviously. And it could also be that the sheer weight of the demand and the shrinking supply eventually propels Bitcoin past this hurdle. But it's been tough going so far.
Yeah, especially, and to your point of the wallets, right? I think I noticed some of them were wallets that hold 10,000 of Bitcoin, right?
Right,
just moving, not moving to an exchange, but just them moving.
Just to another wallet. Yeah.
People draw their attention to these movements and these facts and these on-chain activities, and without knowing what's next, so it adds another element of uncertainty, right? So
right, and right,
add to
it may all work out well somehow, that, maybe some OTC trades are done with central banks, and then central bank reserves get going. And I don't know, it's not necessary that people will start dumping huge amounts of Bitcoin, right? But there is just concern. There's definitely been concern around these wallet movements, especially because the market kind of assumed that the Satoshi, and these may not be Satoshi tokens, that's also speculation, but the market assumed that those are like lost forever. So if suddenly there's, in people's minds, that was gone from the supply, and if it's part of the supply, then you have to kind of readjust for that there is actually more circulating supply than the market assumed.
Yeah. So that would be a short price correction, correct? Yeah. Right. And so since we are moving on a little bit now from broader crypto topics into, we've gone, I think the ones that have been here for longer, the OGs and the degens, they've all seen all sort of summers. They've seen DeFi summers, they've seen NFT summers, and so this year it appears to be stablecoin summer. And while the degens and the OGs might not be too excited about it, we have to ask ourselves, what's the driving force behind this excitement on stablecoins?
Well, the driving force is, first of all, regulation that is getting put in place. That's kind of the catalyst. It's not yet finalized, but it's made huge progress, and it's on track, and it's very likely to be signed into law. The time frame now after it passed the Senate, after various, there was pushback, conflicts of interest, and so on, and that was basically put aside, and it passed the Senate. And there's also kind of in Congress a lot of support for it, and obviously the administration is very keen. So this legislative progress is a catalyst, and also the intention of clearly governments, and the US government in particular, to see this use case thrive. And we're seeing large banks they're planning to launch their stable coins, also large retailers, and so on and so forth. So large institutions are putting the infrastructure in place. They have all sorts of plans for in this market. We saw JP Morgan, doing the deposit token. That's not exactly a stable coin, but it's kind of similar. So it's all of this is happening, and on the back of that, we have seen the example of the Circle IPO absolutely shooting the lights out, and there have been other examples. Tether doing a protocol that's going to process this, stablecoin focused protocol, and then raising deposits for that, and that got sold in minutes. It was filled in minutes, and they kept increasing the amount. So clearly, the market is very enthusiastic. There is a lot of demand, and there's also the narratives are so frothy about stablecoins that this is going to be a huge use case for crypto, and it's crypto's so far best, most established, proven use case, and so on and so forth. And that is true, and to some extent, I'm just somewhat concerned that maybe the enthusiasm is a bit exaggerated not about whether stablecoins will happen or to what extent, but how much it's going to affect the crypto market. Is this really something that decentralized projects will benefit from? Because, for example, if stablecoins are used for settlement purely as a backend, which a lot of TradFi is talking about, that will be done on private blockchains, and that will not really touch the crypto market. Maybe to a very small extent, if for example, they spin up a private L2 on Ethereum, and a little bit of it settles on Ethereum. Maybe there is a little bit of a use case, but actually you could see how huge volumes could get executed on stablecoin rails just because it's more efficient and makes more sense, but that doesn't actually generate fees or revenues at all, or very little for any crypto project, right? So that's one question to ask when the market is really enthusiastic. The other is how much opportunity is there in retail stablecoins, and to the extent that there is, who cares about regulation? Because there is definitely a huge use case for retail stablecoins in emerging markets and cross-border remittances. But that use case for that use case, US regulation is not relevant. They have been using Tether. Tether has overwhelming market share in that. It's growing organically, but that's not going to accelerate because the US signed some regulation into law. So that catalyst is not relevant to that use case. If it's going to accelerate beyond, it will be for other reasons, and other reasons could be, for example, incentives provided. And then, there has been talk, for example, that the US wants to turn the de-dollarization around. So they could, and I'm not saying they would, I'm just kind of throwing out ideas of, what could really accelerate the emerging market stablecoin trend. They give everyone who opens whatever US stablecoin that they favor, opens a wallet, they get $10 or $1 or $20. That's like this kind, or interest on it, or some kind of, some kind of incentives. In emerging markets, that could be powerful. People would say, wow, I get dollars, I want dollars anyway, and I get some for free. And, so there are situations that can really accelerate the adoption, and the organic adoption is already growing, but it's not growing exponentially. It's not huge anyway, and it's growing, gradually. In Western countries, developed markets, it's even harder to see why people would switch to using stablecoins. There isn't a problem that stablecoins fix for people particularly. So again, it will come down to incentives. And I think if there are incentives, for example, PayPal is now offering a yield on the the PayPal USD stablecoin. That's an incentive, right? So let's see how that goes, and what the regulation will allow people to actually offer, because yield-bearing state, like they're sort of offering this they're packaging it as a benefit that, but yield-bearing stable coins for now not allowed under these, the regulation that is going through the legislature. So, but it could be other forms of incentives and benefits that they find a way to provide. And that can actually get people to switch. But barring that, we'll basically have to see how this gets implemented, because just the fact that a ton of US banks and global banks around the world issue their own stable coins, that doesn't mean anybody will use them, right? So we have a business case if there's user adoption, and that is not exactly clear. How that's going to unfold, and whether that's just going to be back-end settlement, it's going to be retail use, what is going to incentivize the retail use. So I think we'll have to wait and see. It is bullish, but is it a little bit bullish, or is it very, very, very bullish? And how relevant is it for crypto projects? We don't know yet.
Yeah, and I think out of everything that you've just mentioned, I think what we can say is that TradFi and crypto has never been so close together as they have, with these movements that are illustrated by these movements and by that demand for stable coins, right?
Yeah.
So I think that is what is very interesting to see as we are in the summer of 2025. And usually we will see in retrospective if it was stablecoin summer, right? Yeah. So it's just very interesting to see how the two industries continue converging and how much closer they're getting.
Yeah, very, very much agree. Yeah.
So maybe on the last topic, someone that's you're very passionate about, it's always ETF approvals. So it's interesting to see, speaking about this bridging the gaps between TradFi and crypto, right? We did see some significant news coming out from the ETF approval side recently. Staking Solana instrument approval has been here. I don't dare to call it an ETF because you will educate me on what it actually is and what it means. What implications does this have for this market and for the bridge in between crypto and TradFi?
Yeah, like right now, this is significant in catalyzing more traditional investor demand. It's a bridge that's necessary right now. It will take so much longer before large traditional investors are set up to engage with crypto spot. What we have seen, as you mentioned, these recent significant developments. One is that this Solana staking ETF went live a couple of days ago. Now it's actually a C corporation, not a fund. Like ETF is meant to be a fund, exchange traded fund, right? So actually the legal structure is not that. It's called an ETF, but it isn't actually that. However, it did go live. And it's important that the SEC sanctioned it, reauthorized it, and they also allowed it be the staking feature. So it's all pointing in a positive direction. To be honest, the day one inflows were not great, but that I don't think that that's even necessarily very important to focus on right now. But then the other thing they also authorized is one of Grayscale's trusts, which is an index. It has 5 tokens, Bitcoin, Ether, but also Cardano, Ripple, and Solana. They authorized that to be converted into an ETF. So now the underlies there beyond Bitcoin and Ether that were basically authorized. After they authorized it, they actually took a step back and they put a pause on the actual launch, which we're not, of course, we're not sure why they did that, but the speculation is that they may be actually going to give us standardized rules for ETF issues. So instead of approving ETFs one by one, basically they say that if the underlying token satisfies the following criteria, and if the ETF satisfies the following criteria, you don't need a case-by-case approval. You can go ahead and launch. But if you don't satisfy those criteria, then you have to come to us and we have to talk about it. Now, if this is the case, now again, this is speculation because they gave the approval and then they put a pause on the launch. So, and they had been talking about these standardized rules for a while, suggesting that this is the direction they want to go. If that happens, that would be hugely positive. That would really open the floodgates. And I think I always said this, the single token ETFs to me are far less exciting than the index, the passive products, because passive investment, there's huge demand for passive investment, and an asset class generally for any asset class, and an asset class that people are quite unfamiliar with and new to. Of course, passive investment is a very logical way to go. So I think if more ETFs can launch, I think this will open the doors to a lot more demand to come into crypto, and it would be very positive. And I think we're seeing the signs that we're going in that direction.
All right, interesting, super, great, thank you, Catalin. Let's say we've exceeded our half an hour a little bit as usual, but it's always interesting to unpack all sort of themes driving crypto and the macro environment. So which brings us to an end now of our summer edition here on the 8th of July. A big thank you to Catalin for unpacking and unwrapping all of those important themes. For a deep dive into this and other important topics, download July Investment Outlook, which is published by Catalin. You can find it on the Sygnum website under Learn section in Research and Education. And please also visit our website to join our community on LinkedIn and all other social media channels to stay up to date on launches and news and research and everything. We wish everyone here a continuous, enjoyable, nice summer. We will review later on in the year if it was a stablecoin summer or not. So thank you very much, everybody, and looking forward to seeing and hearing all of you in August. Have a good rest of the day. Bye.